You want to tie up the property and then be able to test it with a group of good investors that would say, have you looked at this? Have you looked at that? Guys that I would have that were my friends and family were my biggest critics. Guys I'd made a lot of money for, but they were also my biggest critics because they would always say, Mike, this doesn't seem right. And it was good input. You're probably going to have to edit that crap out too.
I kind of got familiar with the world of syndication and raising capital in 2020 because I lived through the 2008 crash and everything, but I didn't really know what it was at the time. My firsthand kind of experience, kind of seeing everything, like what the differences are, kind of the business how it was when you were kind of seeing it and much more active in that side versus now.
Technology's changed everything. I mean, we just didn't. Hell, when I started, we didn't even have cell phones. I think my first cell phone was late 80s, a Motorola brick. For us, when we started, we used the technology of the time, which was snail mail. And we just would mail to known investors that we'd get from the title companies in areas that we thought were probably overripe and couldn't make any money, but they were sitting on a lot of equity. So that was, back then, was anywhere in California, primarily the Bay Area. And then we would invite them to just come out of the real estate they were in there and take it and do a 1031 exchange into another market that was recovering, someplace where job growth was happening, and you could buy real estate cheap enough that you could get a decent yield on it. So it was not a hard thing to pitch, but it was intensive. We always had 4 or 5 crews somewhere, either fulfilling what we called buying tours or market orientation tours in the recovery markets where the real estate was hot. And then we had another crew that was going in and talking to the investors in the areas where they were losing jobs or you couldn't buy real estate that made a decent return, if any return. Very common in the Bay Area, they were losing money but trying to make it back on appreciation. So it was kind of a war of attrition to see, if you could keep making negative cash flow payments on the mortgage and hold it long enough to where you make it back in appreciation. So it was a different world, different times. And then the markets real estate markets were really horribly inefficient because we didn't have data. So you relied on a few trusted brokers and a few trusted appraisers to give you a sense of valuation, within the areas that you were interested in. But now today, things are getting a lot more efficient because you have ready access to performance data for pretty much any market in the United States and the tertiary markets. So that's a major advantage that we didn't have. Of course, property information is ubiquitous; it's everywhere. Interesting time. If you were starting in 2008, that's the one time we did one syndication in all of 2008 and 2009, one syndication. But it was $1.2 billion. And it was a failed bank, which we bought at 4.5 cents on the dollar and prosecuted the debt at 48 cents. I think you and I talked about that before.
Yeah, we did a trophy.
Yeah, a little tombstone. Yeah, that was.
So that was basically 2 years of no deal flow except that one that you focused on.
Yeah, but we had 1,100 loans that we had to prosecute over 11 states. Most of them were in Utah, interestingly enough. It's the only time I ever made an investment in Utah, outside of my own house or the office building or something. But yeah, it was interesting. They were trying to force Zions Bank out of this market. And it was the Arkansas National Bank. I just thought that was so obtuse that they would come from Arkansas to compete with Zions in Utah.
Yeah, okay, so that makes more sense. So when did you buy it, and then how long did it take for you to execute on all that?
We bought it. We bought the second FDIC failed bank package of toxic loans. So that would have been early 2008, I think, 2004. Probably about summer of 2000. No, because I was negotiating that from the back porch of my house in Tucson. So that would have been winter. So winter of 2008.
Yeah, I think that's when 2008 was when the bank started really failing, like truly failing.
Yeah, well, it was what really nailed the lid on the coffin was when the AIG, the world's largest insurance company, couldn't pay the premiums on the reinsure on the derivatives. That was when they started bailing everybody out. That's when the FDIC got involved again. So it was an interesting time. It would have been the very best time to get into real estate.
Yeah.
I don't know if you knew that, but it was absolutely the very best time.
So fourth generation, I knew your dad was a builder just because you shared that with us. So
Yeah, he was a home builder.
was his dad and his dad's dad also?
Yeah. His dad's dad, my great-grandfather, he was big into real estate, but what he did is they started a company that was Good Peas, and Good Peas was out of Logan, and they started buying land for farmers to kind of like sharecrop, but on a sort of different basis. And then what they did is they canned all of their stuff. And that company became the largest canning company in the United States, and it sold out to Del Monte. Slightly different take, but back then that was what was big, was farmland. In Utah, that was a big thing. They bought the first 22 cars that were pickup trucks that ever came into Utah, and they were hauling farm produce to the cannery with it. I got a picture of that somewhere. That's kind of cool. My problem is I never had a life outside of real estate. My golf game will never be good. But I mean, on Thanksgiving, we wouldn't be talking about football. We would be talking about, real estate deals.
So did your grandpa take over the canning business, or did they sell that before he was?
They sold it before, but he took the money, kept investing in real estate. At one time, he owned the land where the Cottonwood Mall is, but he was going to do the first indoor mall in Utah on that site, and ended up selling it to Harmon instead. They were pretty big players in Holiday, this area.
When you were doing snail mail, because I remember back in those days as well, sending out. What are some of the tricks that you used? I mean, we used to do lumpy mail. We would do postcard mail. We
were the first one to hire stay-at-home moms to hand address envelopes. And that was Chuck that did. You probably remember these guys because they were kind of real estate gurus, and they'd handle our marketing for us. Richard Allen, Bob Allen's brother. Yeah. And it was, who was the guy that did corporate engineering?
Something Moose Ranch or whatever, biggest cabin and.
Yeah, I think something like that, yeah. That was him. I can't think of his name right now. And Chuck, who was the guy that did, he was the attorney that did asset protection. Three of them got together and formed a company called McKinley Institute. Chuck says, you'd probably get a better open rate if you just hand wrote the envelopes. And so we just hired a bunch of stay-at-home moms, like a nickel an envelope or something like that. Mm-hmm. And I would say that we didn't necessarily always got the best handwriters.
Well,
because we had a lot of them come back not deliverable, not legible address. Yeah, that's how we started. It was doing it that way.
So was it letters, or was it, did you do like invitation style? Do you even remember? Were you a part?
No, it came kind of like a newsletter, because we personalized it. When we printed it, we would, because we got the information off the tax notice. You own a fourplex in such and such location. That, here's what's going on around in that market area. And we suspect that you're probably losing $200-300 a month on that. Based on when you bought it and how you bought it. Mm-hmm. So we had a lot of information that we gleaned right out of the tax records. And I talked Nate into getting me a Radio Shack Model 1, which ran on 8.5-inch floppy disks. And we mail merged all of those. So we databased all of the information off of the tax records. So you bought at such and such located time, and based on that, you're probably losing X number of dollars. And we knew how much the mortgage was on it and stuff. So we had a pretty rudimentary understanding of how that property was performing for them. Mm-hmm. And besides that, you've got job loss here and job loss there. That rapidly changed. The Bay Area then became Mecca for emerging technologies, but back then, I wasn't there. And so, well, and that was the kind of the mantra, because Garrison was a pretty good economist. He taught at the University of Stockholm, and that was, I threw in with him. And he says, I'll do all the market analysis and you do the, actual fulfillment. And as it worked out, I did all the market analysis and the fulfillment. Garrison didn't really want a job anyway, but I was enthralled by it, And we used to have debates that would just rage for days over, traditional econometric modeling versus how things really work in the real estate markets. And that's when I developed my own econometric models, and those are not being taught through the MRED program on the different universities. But they've been obviously revised quite a bit. Dr. Eric Krauss and those guys kind of put some strong mathematics behind it and stuff like that. So I guess I was the theoretical contributor based on my knowledge of real estate, and then they tied some real math to it. But anyway, that's kind of cool, I think. But we were using those econometric models to decide where we wanted to go to get people to give up their real estate and show them where they need to put it. And you do it on 1031, and these guys would go from, like I think we mentioned, those guys would come out of the Bay Area paying $200, $300, $400 a month to own the real estate and trying to make it back in appreciation. And they'd have 2 years, they'd make a killing. But ones we were particularly in, so the one that had to held it for 2 years, because we knew that they were going to make their money back and they were going to have a big chunk of cash on a 1031. And we'd take them out and buy them 20 units in Tulsa, Oklahoma, where Whirlpool just moved their range manufacturing facility out of New Jersey into. And we knew we were not going to get those guys, but the econometric models that we used said that for every base employment, so anything that brings money from outside the market area and brings it in, like you're manufacturing Whirlpools, they're not going to sell the ranges and the dishwashers all in Tulsa. Mm-hmm. They're going to sell them throughout the United States. So that's base employment. It's bringing money from the outside in. And so we knew that those guys could probably afford houses that were moving in to take those jobs. But we knew that they were going to create for every one of those jobs, they're going to create about 2.3 to 2.5 ancillary jobs. Those are the butcher, baker, candlestick makers, the burger flippers at McDonald's, the guys that did your laundry or whatever. Those are apartment dwellers. So we knew almost with certainty how much demand was going to expand. So all we had to do is just look for where those base employments were going, and then we had about a 2-3 year window to get into that market. And God, we were buying back then, and this will really date me, but we were buying C plus to B apartments, probably 10 years old or right around there. We were buying those for $20,000 to $30,000 a unit. Wow. Now the land value is that per unit. So.
Sounds crazy.
Yeah, and it's like, what was really interesting is the philosophy we had is that you can buy the property completely wrong, but if you get it in the right market with the right lift, mm-hmm. You're a genius. 6 months later, year later, you're a genius.
We went through this recently with the whole market, right? We went through that where all these people were looked at as geniuses because they were buying at the right time, really.
Yeah, and that was a national trend. And the reason being is we were coming out of 2008, 2009. Mm-hmm. But then that quickly went to, like Ethan, you're saying is that it quickly went to these guys that were, my brother-in-law had made a killing out of it, doing that, and he's not that smart, Yeah. So I'm going to go do it. And they were paying, I saw deals in Phoenix when I was interested in the Arizona market that were 80s built properties that were selling for more than replacement cost. Yeah. And it was like, guys, that's not going to work. Mm-hmm. It's just not going to. And you saw what happened. It was ugly.
Switched around real quick. And I guess that would be the fear of something like that. I guess on the other side of that, as I'm listening to you, and I'm sorry to take up all your time here, but
oh, no, you're good.
You probably saved a lot of people from getting hurt in real estate, because I remember all the people that were buying based on appreciation. I mean, I knew one guy, he was in Las Vegas, and he was just buying every property that he could possibly get a hold of. And he didn't care whether it cash flowed or not. A lot of his properties negatively cash flowed, and he would just buy them up. He'd let them sit for a year, or not even a year. I think back then it was probably 4 or 6 months. And then he'd go through and he'd refinance that whole portfolio, pull out a few $1,000,000.
And no taxes on it.
Go out there and buy some more. And and I mean, obviously when the market crashed, he lost everything, because of that strategy. And that's where, with what you guys were doing, you probably saved a lot of people and actually shifted them into a cash flow model.
Actually, though, we didn't. We took them out of the Bay Area, a lot of money. A lot of that came out of the Bay Area. A lot of it from Texas, but a lot of it from the Bay Area and some from Southern California. But we took them out just before the tech boom. And then real estate went nuts, depending on where you were in the Bay Area, but it just went freaking nuts. But the difference is that these guys were now making cash flow. If you looked at it on an internal rate of return basis, they were making more money buying cash flow and appreciation. Because you're still getting appreciation lift in the areas where jobs were being created. We were in Jackson when Toyota announced. We were in Alabama when Mercedes announced. We got very, very good at prognosticating where jobs were going to go, get our people there a year or two ahead of time, because we looked at all the factors that led to it. What was your cost of operational costs? What was your power, human resources, those sort of things. And you could identify where manufacturing was going to go, or where technology was going to go later on. We got pretty good at figuring that out. But you just started thinking what does a corporate relocation guy think about when he thinks about where we're going to move and build our new plant? What's important? For tech, it was always power, availability of power. Utah would have never had a tech industry if California didn't get Enron out of business. When Enron started doing the spot market on electricity and bought what was CalEd or whatever their name is, and they bought Rocky Mountain Power. They ripped it off from us and sold it to California for twice as much. And then every once in a while they'd have those rolling blackouts. Hard when you're in an environment where you need a lot of electricity and they cut your power off right in the middle of the work day. So we ended up with it coming back here. So we ended up, with the Silicon Slopes because of that.
They went and found gold. They had money they needed to invest. So there was a banking and finance district to go spur companies across the country, and then became a sector for that. And then
it was gold, and it was timber, and there was a lot of stuff but it was just naturally heavy natural resources there.
I never even thought about the fact that tech companies would need power. So, and I also know water.
They need the chip manufacturers need water. What the hell they do with the water? Now, Coors, for example, if you go up to Golden, Colorado, there's a river that flows into a building and it comes out a stream on the other side. Now, that's a proper use of water. Now, what chip manufacturers need water for, I have no idea, but they need a lot of it.
Yeah, I heard there's a plant in Saratoga. It's a NSA plant or something like that. And I forgot how much water they use, but it's 5 or 6 figure gallons a day or something like that. It's crazy.
Yeah, you're talking about the one just down here.
Yeah.
Yeah, that's 11 stories underground, and NSA uses that to listen to us. I don't know what it is about the government. We were in Lubbock, Texas for a while, and then BRAC came in and shut down that Air Force base. And they left a CRE supercomputer for the EDC. And they hired a really bright guy, and he says, let's just turn the barracks into office space and then lease the CRE supercomputer for people who need it. And it's so one of the amenities in the common area, part of being there is we get access to a CRE. We're in. It was probably the fastest computer at the time when they did it in Lubbock, Texas. Lubbock was cool because of Buddy Holly. I mean, we were, all the time I was investing there, we were hanging out at all of Buddy Holly's haunts.
So at what point should a sponsor, move away from a friends and family kind of raise and more to a sophisticated or more institutional capital, like accredited investors? Is there a good point?
Yeah, that's a really good question. I'll tell you why. I don't think you should ever, a sponsor should ever, and I'm going to tell you why it's important, but I don't think a sponsor should ever move away from friends and family rounds, because the way the security laws are written, you can do a pre-subscription agreement, to raise money, and you can do a friends and family round. Every once in a while, I hear a sponsor talking about, we're just doing our friends and family round. And the next question you're going to ask, well, are you going to go, 506C on your, because when they tell you that, what they're doing is, we've got a property in mind, we want to test it, and we want to raise enough capital up front that we can tie up the real estate, and we can do, because that process of just tying up a piece of real estate, depending on what it is, our typical earnest money was like 500 grand. It didn't start out that way, but if you're making 5 or 6 offers a month, it started turning into, real cash outlay. So we just go to guys that were insiders with us, and we might give them a little bit of a pref, or a little bit of a bump, a little bit of the GP interest to do that. But so I always think that's kind of important to keep those relationships. I didn't really have that many friends, and I should, family wasn't, I never wanted my family investing with me. But I had a lot of real estate investors that I treated as real close friends. And they would allow me to go test the waters on a deal before I started a full raise on it and started spending serious money to get it done. But so I always think that, but I think probably you start exhausting your ability. People maybe have a lot of wealthy friends or a lot of wealthy family members that if they get hurt, we're not going to disown you kind of thing. But I never could imagine taking my mother's money and investing it. If I lost any of that, it would be, oh God, I can't even, not that I've lost any money, but that would have been a bad experience. But at any rate, we would exhaust that relationship probably at about $2 million worth of capital that would be deployed. And so our typical raise, when we got to where, we were doing 200 unit apartment complexes or 150 to 250 units, our typical raise back then was about $15-20 million. So we were driven to, bring, and we brought in not only accredited, but qualified. So they had $5 million of liquid capital to invest. And we grew that pretty quick. And then we started thinking about, because our cost, the way we're originating new investors, it would cost us $2,000 to find one of them. And it was costing us another $2,000 to develop the relationship with them before we could start, counting on them to invest with us. And so we started thinking, well, we need to grow faster than that. So we started getting institutional money. We brought in money and we brought in some other money. And we found that was probably our ceiling. We brought in 3 deals worth of institutional money. And those guys didn't know anything about real estate. They just knew how to get people to invest money. But they think they knew everything about real estate. And so all 3 of those we had to buy out. We had to buy out our institutional investors because they were driving us nuts. It's like, well, why are you spending money on fixing up the units? And it's like, I don't know, maybe in New Jersey slumlording is a thing, but it does not fly with my investors, So, that was kind of sort of things we were, dealing with. That sort of defined our window. So we knew that we were going to be even though had pretty consistently $1 billion of assets under management, we knew we were going to be boutique. We were not going to be another Lincoln Properties or anything like that. Just because of the limitations of equity. We were more comfortable with the accredited investor and an occasional qualified investor. And the qualified investors drove us nuts too. If we finally, Kent, who was really pretty smart, he says, nobody gets more than 20% of any deal. They have a tendency to run the meetings, all of that sort of stuff. And it's like, so you can invest up to 19% of the total raise, and that was it.
I think that's a lesson right there. A lot of people are out there probably dealing with those same challenges. They find somebody that'll bring in all the money. I guess you were talking, Dave's got that issue, right? Where he's got a guy that'll fund all his raises, but then the guy turns around and wants to row the boat, and Dave doesn't like it, but he also doesn't necessarily want to go raise the money, so he's on this back and forth.
And that's an ultra wealthy family. I can't say where, but that's where they're out of, but nor the amount of money they're moving in, but they're moving a lot of money in. They're going to probably fund deal. And I told both of them, I said, it's all roses and champagne when you're courting. Wait till you get in the trenches. What's the golden rule? Who has the gold makes the rules. You'll learn that the hard way. If they invest, they're investing what, $1.5 billion with Dave on a brilliant plan. I mean, I love the market that those guys are in. And these guys, never really been in real estate, but they see the need for certain areas that are being way underserved in the United States right now. Same thing with same thing, and it's like all of a sudden they're going to be the real estate authorities. And here's that's been doing his, the segment he was in. He was the biggest in North America. And it's probably one of the fastest growing in his market segment. And those guys are going to come in and probably start dictating the rules. And I know that might be tough. So anyway, that's I just had a window that I was comfortable in operating in. So I always like to have friends and family around, because one of the things I see that these guys are making a mistake with now is that you want to tie up the property and then be able to test it with a group of good investors that would say, have you looked at this? Have you looked at that? The guys that I would have that were my friends and family were my biggest critics. Guys I'd made a lot of money for, but they were also my biggest critics, because they would always say, Mike, this doesn't seem right, or did you consider this? Or that was good input, because where you don't want to find that out is when you, in the 11th hour of your raise, you're $1 million short. And it's like, why can't we get any more money on this? And it's because some things that you didn't consider during the due diligence part of it. So friends and family, good. Never get rid of that.
So typically for bigger raises, that's kind of when you would tackle.
Yeah. And if you don't mind hiring a boss, go ahead and take bigger money, family office money or institutional money, or just work with a bunch of accredited investors that you build a good relationship with that are too busy doing their day job.
So for like mid-level GPs, people that have done maybe a couple deals, how would you recommend they kind of like think about their credibility in sense of talking to accredited investors? Maybe they're still kind of new, but they've done a couple deals. It's kind of an awkward spot for investors to kind of fully trust them. What would you recommend to kind of help alleviate that?
Well, first thing is to be honest about the facts. The guys that seem to do really well learned their trade from somebody else, and then said, yeah, I was syndicating with so-and-so. And I was just talking to a guy that was in that boat. And he said, well, have you syndicated real estate before? And he said, I've never been a syndicator before. Well, what were you doing before that? Oh, I was the number 2 guy at BlackRock running their real estate portfolio. Now, instant credibility. But how we overcame it is I knew real estate. My partners, I never had a partner in any business that did real estate before. Garrison was an economist, Nate Hanks was a CPA, but I'd always done real estate. So I had always sort of a track record. Joe Milner was a partner of mine, and he was in oil and gas. When he came in, his family had invested in Snar Development, and so did my family. and they were building shopping centers, for example. So what happened is that they came to me because they said, "You're the only guy that seems to understand how to do shopping centers." And it's like, well, we've owned a couple of them, you know, you're hired. And then when we went out to raise money to do where the Harmons is in Roy, for example, that was one of ours. That was our first one, the Roy Marketplace Plaza. And we went to Joe's family, who was was in the oil business, and we syndicated to them. So we got 2 or 3 oilmen. We got their attorney, the Queen's Counsel for all of that gave us credibility, you know. But yeah, so that, you know, that's how we kind of grew into it. But if you've got the background, or if you can hire people or bring in a key man that has had that kind of experience and put them on your GP team, you know, that overcomes that. But the first thing you got to do is just be honest and say, this is our 3rd syndication as a group, or our 2nd syndication as a group. And then when you start doing your pitch, and I was listening to Kent talk about this the other day. It was on that last, when we talked to him on the phone. He starts with, here's the things I'm kind of concerned about with this deal. First thing he does right out of the gate is, Ethan, tell me about yourself. Why are you investing? You know, what are you looking to accomplish here? Now I want to make sure that we can meet your expectations. So he gets you talking about you. And once he's got a pretty good understanding of where you're coming from, what your expectations are, whether or not you can afford. And I've heard Kent tell guys, you know, your net worth is, you know, $1 million. You know, most of that's back then was tied up in your house in California. You know, that was when they were still qualifying a house, your private residence. And you've got $100,000 to invest. You want to invest 75,000 or 100,000 of that with me? Any good I'm not a financial advisor, but if you had a good financial advisor, he'd tell you to spread that out. You know, so that was the kind of relationship that he would start with. But he said, you know, maybe it's more appropriate for you to look at 50,000 of that. You know, it might be a good starting place for you anyway. And then from then he would go in and say, okay, let me tell you about the deal. Here's the things I'm concerned about this deal. Here's the things I like about it. Here's the things that are the strong forces that are moving the value of that real estate. You know, the strong market conditions or whatever it is. And by the end of that, they had a pretty good feel for what they're investing in and who they're investing with. And because of the way we approached it, we came off credible right out of the gate. You know, and a lot of people said that when you talk about the weak points of yourself or the weak points about the deal and what you're doing to overcome them, that it ensued market or confidence in who you're investing with. And so that's the place. I many times I've listened to guys and they just start going right into the pitch on the real estate, you know, and they just gush about the great aspects of it and don't even address some of the issues with it. You know, and that's where you lose credibility.
Doing proper due diligence, qualifying the investor, but also if you're lacking experience, just being upfront and honest about it, and also maybe bringing on someone else that may be able to cover kind of the weaknesses that you may not be able to do.
Absolutely. And that's why I never hired another real estate guy, or never had a partner that was another real estate guy. I was a genius, for example, at top line performance in real estate. I could make the rain come down, but I could never get to a bottom line. You know, could have been that I was enamored with sports cars. It could have been, who knows what the hell it was. But I never, you know, I never turned monster profits until I hired an accountant. You know, or not hired, I brought in a partner that was an accountant because I was weak in that. You know, and all of a sudden, I could do great top line performance, and somebody was making sure we got bottom line. That's like, what do you mean we've got $7 or $8 million in the bank? How did that happen? You know, that's impossible. No one could do that. And it was kind of the same thing when it was Joe Milner. His family was in the oil business, so he had the connections. and the fact that they're already invested in something that, where the guy that was running those investments had health problems and we had to take him over, that made it a ton easier because they were just looking for a life preserver. And it's like, well, that Anderson kid, he's been in real estate all this time. He's done a couple shopping centers. Why don't you go talk to him?
Can you also speak to, coming to today, how important it is to have a presence online? How we see some of these people that when they have no presence, it makes it real difficult for them to have a conversation.
Yeah, I mean, it's today, yeah, there's so many things about technology that has changed everything. First of all, the industry for me, even though I worked 7 days a week, it's expected that you'll answer the phone at any time. If they want to know more about you, they expect to be able to find 20 videos about you, and like you, Ethan, you just said, you were like, I searched you on the web, I looked at Real Source and who they are and their track record. So all of that is that's probably the biggest way that people build confidence in somebody. Partly, I mean, that's true to a point. Like, you can find out somebody's been a convicted felon online. That's simple. I mean, that's easy now, and you can find out if they've got financial problems. All of that stuff's easy to discover.
Yeah. We're making it easier, but you're right.
Yeah, no, it does. And I think asking for the disclosure because people can fact check. Oh my God, my wife, when I got her turned on to technology, first started using it, she fact checks everything I say. I mean, it's like, I love you. I'm going to fact check that. Gets on my Facebook account. So, I mean, it's so easily verified these days. And nobody's going to have that perfect lily white, background. I mean, as long as you haven't like ripped off people, been convicted of a felony or breach of fiduciary or, but, like I was looking the other day, I was looking to invest in a guy that was doing a syndication with us, and we were working with him, and I found out when I was just doing my background check on him that he was living in an apartment. I don't know why at first I went, what the hell? This guy should have the financial wherewithal to buy his own home, you would think. And then I started thinking about it, and I don't know who it was, or we were talking to somebody. He says, well, what if the apartment was in downtown Manhattan and was costing him $20,000 a month to live there, because we have apartments like that, and it's like, yeah, okay, that could be, but it was pretty much similar to that. He was in part of California that, that he probably didn't make sense to buy a house, but his rent would have been, more than most anybody's mortgage. So, but that's how you find out about people. But online presence is right now. That's how I learn about most people, is just watching their blog posts and video posts, vlogging posts. So, yeah, it's critical now.
So what have you seen from some of the most successful GPs that you've worked with or maybe have seen, and kind of maybe like a tip or something that you've seen that these guys do to keep their investors warm in between deals, kind of warming them up for soft commitments, kind of in between deals and stuff like that?
Well, you should always have a deal going, first of all. I mean, the most important thing that you can do or be to an investor, eventually technology is going to get rid of experience. The guys are going to end up running the real estate industry, the guys that understand technology the very best and how to deploy it. AI is taking it over. When quantum computing comes around, its ability to prognosticate, outcomes and stuff like that, it'd just be infinitesimally better. So even the guys that have been in business for 40, 50 years won't be able to compete with that. The only thing that's going to be left is, what are your fiduciary responsibilities and how well do you execute them? That's uniquely human. AI will never take that away. Eventually we're going to see quantum computing, enter that's already in the fray right now and is proving to master financial management far better than any human being can. So, but fiduciary is the most important thing. And if you just take the time, for example, I'd love to just, aside from when we would do our monthly investor calls, and we did them monthly. Everybody else was doing them quarterly or something like that. We did them monthly. But I'd like to just call some of my key investors and just call and say, hey, Ethan, how's it going? Did, your son Bob, did he get into Duke? Are we going to need to start drawing down some money for you? And, that kind of friendship is the best way. We had a term for it in the company. It was called investor eccentricity. How centric was the investor in our relationships? And we wanted our investors to feel like they were the most important people in the world, because they were our bosses. Now, everybody goes into the real estate syndication. You say, well, I want to be my own boss. So, well, don't syndicate that. All that's going to happen is if you got 30 investors, you got 30 bosses. You got 4,000 investors, you got 4,000 bosses. And if you screw up, they'll let you know. And so I think the most important thing to be is just make sure that you build and maintain those relationships. Know when the kids' birthdays are, their anniversary. Those are important things because they're the most human part of it. And then the most important thing about being investor-centric is providing good information, timely information, pertinent information, and fully accurate information. Don't sugarcoat things. Don't just tell it the way it is. Because that's a responsibility you owe. I remember one time I was dealing with a guy that he was buying some assets from me, and in the contract process, it was so unilateral, his demands, and he was almost like treating me like I didn't have any negotiating room at all. So I just asked my attorney. I said, just ask his attorney. Say we want to add a clause that says in there that you pledge your fiduciary to me. And his response was, that's too onerous. Little did he know that all of government regulations say one thing. You have to put, if you're handling somebody else's money, you have to put their needs ahead of your own. That's fiduciary. So the most important thing you can do is just make sure, even in the downtime, that your investors' needs come first. Free iShares built on one of those principles. If you need access to your money, you should be able to get it.
How'd you keep notes back then? I know how we do it now and it's difficult. What were your note-taking system?
It was a yellow columnar pad. So all of our spreadsheets were done on big columnar sheets, and 2 HB12Cs, which were those look like a splitting wedge. They were even green like a splitting wedge. And both Joe and I, when we were doing that, we were both dyslexic. One of us would do the calculation and the other guy would check him. And every once in a while, I would transpose numbers and Joe would transpose them the same way. So, and then note taking was just those white legal pads, or I used yellow legal pads, but I mean, that's how we did it.
So every time you were going to call an investor, you'd pull out the legal pad and get up to speed on.
Yeah, just like Joe Friday, just facts, man. Yeah. But that was, that's how you did it. And then we started, you got electric typewriters, still carbon copy, but electric typewriters, and you get a little dictator, a little dictaphone thing. And you dictate out your letters. But we were always the first guys to adopt new technology. And Joe and I had to do it. We did the same thing that I had to do with Nate. Is I ended up buying a early Commodore computer or something like that, and a dot matrix printer, because we'd get those big columnar sheets done, and we'd go in to our lender, and that was Craig at Western Mortgage, and he would say, Oh, guys, I don't think you can get $7 a foot rent on your inline space. Try it at 650 and see if it still works. It's like, are you kidding us? It took us a week to do that. It's not like you go change a couple numbers in an Excel spreadsheet. Oh, it was a nightmare. So yeah, technology's come a long ways. But answer to your question in the off times, still the human thing. That's the most important thing, is just keep those human connections. If the only time an investor hears from you is when you're seeking money, you've defined your relationship the wrong way.
Yeah, that makes sense. It's so interesting to hear. A lot of like the fundamental principles seem to be like the same, but the difference that I'm kind of noticing is the technology has made it easier. And I've kind of grown up always hearing that, but kind of hearing things, how you're explaining how things were working, I could really see how much of a difference it kind of made in making things more efficient and saving time and stuff like that.
Yeah, it's kind of interesting. And somebody should do sensitivity analysis on generations. If you're dealing with a guy my age, I'm never going to learn emoji cons. I don't want to know the sarcastic emoji con. But everybody goes, you took that serious? Didn't you see the sarcastic emoji con? It's like, what the hell are you talking about? I had to laugh at Dave when we were talking to him. He says, one day he had it was early on, 10 years ago, but he got his first cell phone. And he's my age, in his 70s. And he said, damn phone quit. And the guy goes, let me look at that. There's no way. And it had run out of memory. And he said, Dave, you've got like 8,000 text messages in here. And that was before they had a gigabyte of memory in them. And it was like, your phone can't process anything. And he goes, what's a text message? And it's like, you guys laugh at that, but it was like, that's crisis for us. And it was like, oh my God, what's in those 8,000 text messages? I've got to read every damn one of them because there might be something important there. So, I mean, my generation, it was things that were written down, things that we mailed. For us, a blessing was when FedEx finally showed up, because we could put a contract in, somebody would have it overnight. Now you can have it, 30 seconds later, and it was prepared by AI. So it's a lot different, but just generationally, and to a certain extent, your generation still has to deal with my generation, because we still got a lot of the wealth locked up. I one time was in a debate with a young guy that was working for me, brilliant guy, and the discussion kind of got heated, and he made a point. He says, you need to rely on me rather than your own background, because I understand technology better than you do. So it makes me a lot smarter than you are. Offensive, but probably true. And I said, yeah, but the difference is between you and I, Adam, is I've got the cash, you don't. And he goes, that's another thing. It's time for your generation to die off and pass the cash on to people that can do some good with it. Couldn't argue with that point either, but it was, yeah. So, he ended up being a competitor. He's doing pretty well, but anyway, that's kind of how that works.
Well, I think to add to that, maybe you can share with them, the technology, the time, the resources, the cost that it used to take to acquire a new relationship, new investor, compared to what we're doing now for people using technology.
I think we mentioned that, but yeah, it was snail mail. That was just painfully expensive as it was, and probably that was probably pretty good. I'll tell you why. One thing that was good about mail is when it showed up in the mail, it had some value to it. An email, we just spend maybe half a watt of energy transmitting an email. and split second to type it unless AI prepares it for you, which that's another thing. AI is doing all my emailing for me anymore. I just started out and they start putting in whole paragraphs. But so everything that you did had a lot more value because you spent a lot more time, more energy, and everything else. So mail was not discarded. It was opened. You know, now today, if you get something in the mail, you assume it's just junk right off the bat.
It's just so much junk now that
Yeah.
people don't put the effort into it.
Yeah, and we probably added a lot to that, in the early days. But I like to think the stuff that we had was added, had some real value to it because it was targeted. Um, but at any rate, by the time we loaded up equipment, met with 200 or 300 people in a hotel ballroom on the coast, we had 5 or 6 people on that crew that would go out and explain to them the economics of real estate and what's going on in their market vis-a-vis some other market where property values were increasing and driven by fundamentals like job growth and those sort of things. We would spend $2,000 to make a connection with those guys. So if we had 300 in the room, we'd have 30 people that would become potential investor clients. By the time we had gotten them to the point where they would write us a check, we spent another $2,000 in developing the relationship. And it was the same thing. It was letters. It was, phone calls. It wasn't, a bunch of batch emails and stuff like that. So that human connection was baked into the cake because that's all you had. So it was a different thing, but it was very, very expensive. But it also had a great deal of rewards because it didn't have a bazillion other guys, that got computers that can, become brilliant at real estate investing. So, and to my old buddy's point, Adam, I have better technology than you do. And that makes me probably smarter than you were. And it's like, probably you're right. That means that you've got everybody as a potential competitor. So the trade-off for it, it was $4,000, and now we're doing it for what, 100, to make that connection. Somebody reaching out on a deal that I was offering. Hell, I never would go to a hotel room in California and pitch them a deal. I might give them case studies of deals that had been done, but that was way too premature. But the expectation now is that you can pitch online and get response. And I see that all the time, and that's just mind-boggling to me. I never felt comfortable offering one of my deals to a would-be investor until I at least sat down with them and had a drink and a meal. That was just taboo. The old expression then was, before you tell me how much you care about my money, tell me how much you care about me. And that was, you never talked, it was ghost talk about money until you'd gotten to know those people really, really well. That's sad. I think that's kind of sad part of the loss. But the other side of it is that you guys are so much more efficient, than we ever dreamed of being.
And I think some of those principles still ring true. It's just we're able to use technology to find them in the moment where they're specifically looking for, the type of project or returns or passive income or whatever it is. But then you still have to get that feeling of you care about them. And I mean, the best way to do it is you truly care about them. And then the other side of it is, bridging that gap and getting to know them rather than, well, you answered about a deal, so let me tell you about the deal.
Well, yeah, and I see people trying to bridge that gap quite a bit. Like, I get these emails today that always just kind of make me chuckle. Let's have a virtual coffee. Well, how do I get virtual caffeine with that coffee? And if so, how is that going to help me? And I used to laugh at that because it would be a Zoom call, but let's have a virtual coffee. And I actually had a guy who was, I think, one of the guys we met through pre-iShare. it was pitching me. It was one of those guys that get you into everybody's blog or get you into.
Oh yeah.
And he said, "Well, let's have a coffee together." I said, "Well, you in Salt Lake?" And "No, I'm in California." And he said, "But I'm buying." And he said, "We'll have coffee." That's like, okay, I would like to see how this is done. And so we got on the call, and he asked me, he says, "What kind of coffee would you like?" And so I gave him, I just like a latte, and he said, "No problem." He said, "You want anything else with that?" It's like, "No." 15 minutes later, DoorDash. I thought it was strange when he asked for my address, but but at any rate, it's just, I still think you got to have that humanistic element to overcome. If you're going to be a syndicator, it's a people business. And soon, it doesn't matter how smart you are, as to Adam's point, technology is going to be a lot smarter than you. And there's technology that's coming out now that we'll be seeing that'll hit the real estate industry that you're not going to be, you almost have to be a computer scientist to run it. And if you are, and you know how to write the algorithms, you know how to write the prompts and stuff like that, that will make you uber successful at anything you do. But it's still going to be a people business when you're dealing with money, and their investment dreams and stuff like that, and kids' college funds, and always be a people business. So those people skills.
Yeah. People skills and character, right? When it comes down to it, that's the beautiful part about that is people who will last, people of character.
My question would be to you, in answer to your question, is what does it take to build a relationship? What's the cost of building a relationship with somebody to where they'll trust you with their money? I mean, you say, well, what was the cost of it? For us, it was 100-fold of what you guys are paying. But half of that amount was building that relationship. Remember? Yeah. About $2,000 to find a guy, about another $2,000 before we'd ask him for a check. What are we spending on that today? And how do we do that in the technology age?
The biggest thing that I've kind of noticed with technology, kind of hearing what you're saying, is you could, like Christian was also kind of mentioning, with the technology, our scale is much bigger, but also for like a fraction of the cost, like especially if you were spending 2,000 to find them, because I'm sure like writing those handwritten notes, sending it out, and then you got to meet them, maybe wine and dine them a little bit more.
That was the biggest expense, was putting a crew of people on the airplane, renting a hotel room, big ballroom, feeding them coffee and cookies or sweet rolls or whatever. That was the biggest expense. And now, I mean, you can send out one blog post and it can reach 1 million people that you've never met before. It's boom.
Yeah, I mean that's the beautiful part that I would say that we have now is you can actually be building a relationship with hundreds or even thousands of people at once, and that's that online presence that we talk about. Is as you're posting those things, it's the same way as if you were able to sit down and have a conversation with somebody, but you don't even know they're looking at it, is the difference today. And I mean, I think we could all probably share scenarios now at some point where somebody was watching us for months or years online and we had no clue because they were doing it in the background. They didn't want to comment. They didn't want to tip themselves off that they were actually watching what you were doing. But then all of a sudden they show up and say, hey, I've been watching what you're doing and I'm ready for whatever that is, right? Whatever your product is. And so that's the key of, one of the things that we're implementing in now with our clients when we're doing paid ads is also a organic strategy of making sure they have consistent income or consistent content going out about the project as well, and who they are and what's going on, so they could be building those relationships at the same time. Because you used to have to invite somebody, go sit down with them, build all that. Nowadays, if somebody decides they want to build a relationship with you, they might stay up until 4 a.m. going through your profile and building all of that as if they're having a conversation with you. And when you get them on the phone, they feel like they know you already and you've never even heard their name yet.
Yeah.
One of the reasons we decided to do the Fundication show for anybody that goes for the sponsor disclosure is to have content that's not about the deal. It's about who are you as a person? What's your driving force? Why are you doing all this? What do you focus on as far as your strategy? It's not because we think that's going to get them a bunch of leads. It's because when the leads come in, they want to go do their investigation, and we want to make sure there's some good content out there for them to find about who these people are they're dealing with.
Yeah, there was a guy, and I experienced this when I hooked up with you guys, and we started doing pre-ISHR. There was a guy, you guys will remember him. he was doing the adult living communities for 50 and above, I think it was. Do you remember those guys? And they were doing some in the Carolinas. Jim Sakini, who was a guy I used to race with, referred me to him. And you were interviewing him on those sort of personal credibility issues. And you were interviewing him in the studio. And he had that buddy that was with him that had that heavy Jersey accent. Tony. And what was his buddy's name? Jay.
Good call. Jay with Hamilton Fund.
Hamilton Fund. And I was listening to him, and I was trying to prompt him on things I think that people want that would build credibility. Like, what would you discuss if you were having dinner with this guy, and you were in a relaxed environment, and you felt you could ask any kind of question? And one of the things that came up, and I don't know how we got to it, but we were talking about. I think I made the remark that I'm not far from needing an apartment where everybody takes care of me, And he goes, "Well, hell, I'm a tenant in one of my buildings."
Yeah.
And I was like, I mean, here's a guy that's just uber wealthy, and very probably similar to my thought process with the guy that was syndicating and was renting an apartment. And it was like, "You live in one of your units?" I said, do you tell everybody that you're the owner of the property?" "Oh, hell yeah, they all know that." Instant credibility. Instant credibility. It was just like, that was so homespun, and it was so direct, and it was so, why would I be afraid to tell him I owned?
Well, especially with him, because he talked about this is the reason we build to the quality that we do is because our family moves into these things.
Yeah. And that was just so homey. You felt like you knew that guy. That would be an answer that he'd give you after 2 martinis or 3 martinis. Yeah, it's just like, yeah, I got to the point where I just felt like I just wanted to move in, so I did. You can get that. You can convey that. But you have to have good videography. You've got to be able to, that's Nick. He's always got the damn camera going all the time, and you just get the candid feel for who they really are.
When you think about our best content has been on these shoots that we go and we spend a day with them. It's not, hey, say these words and we're going to get out. And a lot of companies are doing that. They say, here's your script, say this, and we're out of here. And we go in there and we just spend time interviewing and asking. I'm diving deep into things that they probably think, why the heck are we talking about this? Yeah. But then Nick somehow pulls all the gold out of that and turns it into just incredible content.
But it's a thing that shows the humanity. Yeah. Again, that's the most important part of this. We're in a people business, and you guys show that you're a humane person that gives a shit about their people who you're handling their money. Think about this. You guys don't have kids, but I've had kids. Would you spend more time interviewing a sponsor or a babysitter? And there's been times where every once in a while, because my kids convince me of it, that money might be more precious than a kid sometime because they get pretty cash motivated over time. But my dad used to have an expression about that is, "Dad, what's more important, business or family?" And he goes, "Well, family is always number one. You fail at business, no family." So you figure it out from there.
Yeah.
But it's the same question. Which would you do? Would you trust somebody that, is your offspring without getting to know who they are? You know, what's going to happen when you leave your house and they're with your children? What's going to happen when I give you my money and it goes to a place I've never even seen before? That requires a lot of relationship building, and I don't think we spend near enough time on it. And you guys don't have the tools I had, unless DoorDash starts delivering a bourbon. It's an uphill battle, but it's interesting how technology does that. Because like I said, that video, it was like I couldn't, after I listened to Tony talk that day, it was just like, not only do I want to give you my money, I also want to move into one of your communities.
Kind of what I was taught was exactly what you said. A lot of these folks are not investing in the deal, but more so the sponsor themselves and
First sponsor.
first sponsor, yeah. And so, yeah, just with our sales team there, because in terms of like product, there was like a pretty much a total agreement that like we didn't have the best software product, but what differentiated us was our sales team. So like at every event or whatever, like we try to be as personable as possible. And even if there was an issue with the software or whatever, like most customers would churn, go to other software providers, but that relationship is what kind of kept us, in their like product suite, basically.
Yeah, what you guys exemplified more than anything else was empathy. And I think that's so critical because no one's going to have the perfect software. No one's going to have the perfect solution for everything. No one's going to have the perfect investment. But you need to be empathetic. And if there's a mistake, you need to own that immediately. You know, and I think that's a chatbot will never do that.
For someone trying to raise, $5 to $20 million, what should their investor funnel kind of look like, in your opinion, just based off experience?
So are we excluding friends and family at this point?
Yeah.
Okay. So what was the range again?
For someone looking to raise, $5 to $20 million, what should their investor funnel typically look like?
$20 million, you probably should have a stable of investors right around, core investors, ones that consistently have money and consistently invest with you. That usually should be right around 300 to 400 investors that you've had established relationship with. They'll do most of the heavy lifting, but if you're smart, you'll reserve about $1 million of the raise for new investors. Once you know that you've got the raise done, then what you want to do is start fostering the next generation of investors. So and that allows you to do two things: longevity, and allows you to scale. So when you're starting at the $2 million or $3 million raise, those are the hardest raises you will ever do. Trust me, because they're going to be a wonky deal. It's going to be small. It's not going to be. We used to have this thing. If they show pictures of the investment they made with you at their golf club to the other golfers, I just made this great investment. You got to see this property, and it looks like something out of a Home and Gardens magazine or something like that. Those are easy races. When you're raising $2-3 million, I say you almost have to have 300 to 400 for those. But they'll probably all be new investors to you. That's when the friends and family really helps. If you can get 200,000-300,000 of your friends and family, you can at least start saying, we've got 200,000 to 300,000 raised. And that breaks the ice. So it shows investor interest. No one wants to say, I'm the first guy to commit.
Yeah.
Well, let me get back to you. When you get $1 million raised, call me. So trust me, I remember starting with those $2 to $3 million raises, and they were tough. But one thing I did have going for me is I had met those guys, spent some time with them, gotten to know them, and we did these things called market orientation tours. And so if we're going to invest, you're going to invest in a property that was, the down payment was $2 to $3 million. We took you to the property. We walked you through the property. We took you to the city, spent a week with you in the city. We took you to all the local restaurants where all the local guys go. If you're in Oklahoma City, we took you to line dancing one night. So we had that kind of rapport, you know. Today, I still think you guys can do it because I've seen that happen with social media and those kind of connections. But again, it's going to be a fostering process. So let's face it, just you got to spend money up front. Not like we spend it, but you got to spend a lot of money up front to start cultivating those relationships. So I'd say at the $2 million level, and it's maybe your second, third raise, and you don't have any repeat because maybe you locked up their money and they can't pull some of it out to invest, which I hope pre-iShare fixes here soon. Then, you know, and chances are you haven't flipped either of those two, so they don't have money coming out of a flip or a refinance where you've sold the property off. So new relationships, you better figure on having about the same number of connections to, you know, that 300 to 400 range.